No retirement savings at 45 does not mean you're doomed. But before you invest more, save more, or cut expenses, there's one number you need to figure out first.
Most people skip it. They panic, they open a brokerage account, they start throwing money at index funds, and they have no idea if they're even throwing enough. So they either undersave and still end up short, or they overreact and start cutting things from their life that they didn't actually need to cut. Both are painful. Both are avoidable.
This video gives you the number. Then it gives you a concrete sequence for what to do with it. If you stay through the middle of this video, you're going to walk away with a retirement target that is specific to your income, not some generic benchmark, and a clear sense of what the math actually requires to hit it. Here's the thing nobody tells you. Save more is not a plan. It's something people say when they don't want to do the math. You could save $500 a month for the next 20 years and still retire broke if your target was $1.5 million and you started with nothing at 45. Or you could save $800 a month and actually get there if your income is modest and your Social Security benefit fills a bigger piece of the gap. The answer depends on your number, and almost nobody has sat down to calculate it. So let's build it right now. What does retirement actually cost? Not in the abstract, for you specifically. The standard rule of thumb used by financial planners, the Social Security Administration, and most major research institutions is this. Most people need to replace somewhere between 70% and 80% of their pre-retirement income each year to maintain their standard of living. So if you're earning $80,000 a year right now, you're looking at needing roughly $56,000 to $64,000 per year in retirement. That's your annual target. Now, here's where most people make the first mistake. They assume they have to save all of that themselves. They don't. Social Security, on average, replaces about 40% of a worker's pre-retirement income, but that number varies significantly by income level. Lower earners typically see a higher replacement rate, sometimes closer to 50%. Higher earners often see closer to 1/3. The SSA's own data confirms the average sits around 39%. So your actual benefit depends on your earnings history, which is why the worksheet directs you to pull your real number from SSA.gov rather than rely on the average. So on that $80,000 income, you might be looking at roughly $32,000 a year from Social Security. That means the gap your savings have to fill is not $56,000 to $64,000. It might be closer to $24,000 to $32,000 per year. That's a very different mountain. Now you have an annual number your savings have to produce. The next step is to figure out the total pile of money that would generate it. The most widely used rule in retirement planning is called the 4% rule.
Here's what it means in plain terms. Research going back to 1994 found that 4% is the withdrawal rate that survived every 30-year stretch in modern market history, including the Great Depression and the stagflation of the 1970s. It's a conservative floor, not an average. Use it as a planning baseline, not a guarantee.
So you just divide your annual savings gap by 0.04. If your savings need to produce $28,000 a year, that means you need $700,000 in savings. If the gap is $32,000 a year, you're looking at $800,000. These are real numbers, specific to an $80,000 income, not a $1 million benchmark someone invented for shock value. Run this for your actual income. The formula is the same. This is the number you've been missing.
Now, before you write that number on a sticky note and feel sick about it, hold on. Because there's a lot most people at 45 don't know about how the next 20 years actually work in their favor.
First, catch-up contributions. Once you turn 50, the IRS lets you save significantly more in tax-advantaged accounts than everyone else. In 2026, the standard 401k limit is $24,500, But if you're 50 or older, you can contribute up to $32,500. That's an extra $8,000 a year that gets to grow tax-deferred. And if you happen to be between ages 60 and 63, Congress created something called a super catch-up under the Secure 2.0 Act. Those folks can contribute up to $35,750 in 2026. That's not a typo. Add an IRA on top of that, up to $8,600 for those 50 and older in 2026, and you're looking at a meaningful annual contribution ceiling that younger workers simply don't have access to.
Second, peak earnings. For most people, their 40s and 50s are when income hits its highest point. That means the dollars you're able to put away now are the largest they've ever been. Third, expenses often drop. Kids leave, mortgages get paid down. Some of the biggest line items in your budget start shrinking right around the time you have the most room to redirect cash towards savings.
Now, here's where it gets tactical, because knowing your number is step one, but knowing the order in which to act on it is what separates people who make progress from people who spin in place. Start here. First, make sure you are capturing every dollar of your employer 401k match. If your employer matches up to 4% and you're only contributing 2%, you are leaving a guaranteed 100% return on the table. Nothing else in personal finance gives you that. Not stocks, not real estate, nothing. Do this before anything else. Second, look at your debt. Here's a simple framework that comes from Fidelity's own research. Compare your debt's interest rate to 6%. If you're paying more than 6% on something, credit cards, personal loans, that debt is costing you more than your investments can reliably earn. Pay that down first, in parallel with capturing your employer match. If your debt is below 6%, a mortgage, a low-rate car loan, it's generally smarter to invest the difference rather than pay it off early. Third, max out your tax-advantaged accounts. After the match and after high-rate debt, you want every available dollar going into accounts the IRS can't touch until retirement. The 401k first if you have one, then an IRA. This sequence isn't random. It's designed to give your money the most runway and the most shelter from taxes, which, at your income level, is one of the biggest levers you have. There is one more asset most people at 45 are not thinking about as a retirement resource: home equity. Research from Vanguard found that fully leveraging housing wealth, whether through downsizing, relocating to a lower-cost area, or other strategies, could boost retirement readiness by 20 percentage points for the people who use it. That's not a footnote. That's potentially the difference between getting there and not getting there. You don't have to do anything about this right now, but it belongs in your thinking, because a lot of people are sitting on $200,000 or $300,000 in home equity and treating it like it doesn't exist in their retirement math. It does.
Let's recap what you actually have after watching this. You have a formula for your retirement income target: 70 to 80% of your current income minus what Social Security will cover, divided by 0.04 to get the total savings number. You know that Social Security covers roughly 40% of the average worker's pre-retirement income, but that your actual benefit depends on your earnings history, which is why pulling your real SSA estimate matters. You know about catch-up contributions, and that at 50, the IRS effectively hands you a bigger shovel. You also have a clear sequence. Capture the employer match first, eliminate high-rate debt in parallel, then max out tax-advantaged accounts. And you know that home equity may be a backup lever you haven't fully accounted for. This is not a plan that requires you to live like a monk for the next 20 years. It requires knowing your number, then being strategic, not just aggressive, about how you go after it. And if you want to actually run your own numbers right now, I put together a one-page worksheet that walks you through everything we covered: your income replacement target, your Social Security gap, your total savings number, and the three-step sequence as a simple checklist. It's linked in the description. No email required, just download it and work through it. Here's what I want you to do right now. Drop a comment below and tell me one thing from this video you're actually going to act on this week. Not someday, this week. Maybe it's filling out that worksheet. Maybe it's logging into your 401k and making sure you're capturing the full match. Whatever it is, write it down in the comments. I read every comment. And if you found this useful, share it with someone in their 40s or 50s who needs to hear it. Subscribe if you haven't already. New videos every week. I'll see you back here soon.